want to talk about is cash basis. So, what is cash basis accounting or cash basis bookkeeping? Basically, it just means that you recognize revenue and expenses when cash comes into your account or leaves your account. So, again, you recognize revenue when you receive cash into your account, when you physically receive the cash, and you recognize expenses when cash physically leaves your account or on a credit card. So, let's go with an example. You deposit a check for April services. So you provided services in April, but you deposited the check in May. You would report that sales income or service income in May because that's when you deposited the money. That's when you received the funds. Or an example on the expense side. Let's say you paid a contractor in June for work that they did in May. That would be considered an expense in June because that's when you actually paid the contractor. So cash is very easy to understand. Cash in, we report it as income. Cash out, we report as expenses. It doesn't matter if we had an invoice or a payable or anything like that. Those are not recorded. We don't record actual income or expenses until we've actually received the money or we've actually paid something. So when we think about accounts receivable and accounts payable, they're not recognized on a cash basis. So if you were to provide a service for a client in May, but it's still outstanding, you haven't received that actual income, you would not recognize any income until it's actually paid. So that's cash basis. Recognize revenue when you receive cash, recognize expenses when cash leaves your account. Some of the benefits to cash basis is it's easy to maintain, or it's easier to maintain. Cash in, cash out. It's easy to understand. It's very logical. Report income as it's received or report expenses when they go out. And you have a better idea on money available to spend. It matches your bank account more closely because it's on a cash basis. It's cash driven. And another good benefit is that income is not taxed until it hits the actual bank account. So you're not paying taxes on income until you actually receive it. Now, some of the downfalls to a cash basis is that reporting may be a little bit less reliable. So let's do an example. Let's say you have a client that sends you money, and let's say it's in June. So you receive a deposit for $50,000 in June. You're going to report that income in June. But let's say in August, you have a bunch of expenses related to that $50,000. So let's just say you're a marketing company and someone pays you $50,000 to do marketing for them. And 2 months later, you're going to have expenses like Facebook ads, Google ads, and all these expenses that you're using that $50,000 to record. The reporting is going to be a little less reliable because you're showing $50,000 of income when you receive the money, but you're not actually using those funds to pay expenses until a couple months later. So it's going to look like, hey, we had this great month, but then 2 months later when you have all those expenses, it's going to look like, hey, we had this really bad month, when in reality they should be balancing each other out. Another downfall into cash basis is that you just have less insights into invoices outstanding or bills that need to be paid.